Welcome to the new episode of Inside the Economist's Mind. Today, we're diving deep into the May 2025 Westpac Market Outlook. This is specifically tailored to give you, the learner, a clear and concise understanding of the current global and Australian economic landscape. You shared this comprehensive report with us, and our mission really is to pull out the key insights. Save you time, but make sure you grasp the critical developments.
Absolutely. And we have, well, quite a stack of information here. Covers everything from market reactions to those tariff announcements, right through to detailed forecasts, for various economies, commodities, that kind of thing.
So we'll be unpacking that initial volatility first, the state of play now, and what Westpac sees coming down the track.
Exactly. Think of it as your shortcut to being really well informed. We'll pull out some surprising nuggets, hopefully, and give just enough context to make it all stick.
Okay, let's start with that initial market turmoil then. The report talks about intense uncertainty back in early April. That was after President Trump's Liberation Day announcement, right? And those U.S.-China trade shifts.
Yeah, that really stirred things up. The report points out significant volatility across the board, equities, rates, currencies, a lot of movement.
So markets were trying to figure out the long-term impact.
Pretty much. Trying to decode what looked like a major shift in U.S. trade strategy. It was, a moment of real nervousness.
But then things seemed to calm down a bit in the weeks before the report was finalized, around May 9th.
That's right. And interestingly, as the report notes, this happened even without any fundamental change in trade policy itself.
So how does that work? Initial panic, then calm, even with the underlying issues still there.
Oh, it's fascinating, isn't it? It really shows how sentiment can shift. That 90-day pause on tariffs for countries other than China, that provided some breathing space.
Okay, a temporary reprieve.
And the UK signing that framework agreement with the U.S., even though it wasn't a full deal, it signaled, potential for negotiation.
Right, a sign of dialogue, perhaps?
Exactly. And even with U.S.-China progress being minimal, just the news of upcoming talks seemed to be enough to let markets stabilize a bit. It feels like an initial shock followed by a more cautious sort of wait-and-see mode.
Okay, so the immediate escalation fears eased, allowing some stability. Now, the report then moves to the global growth outlook, and it sounds like a mixed bag.
Very much so. A real divergence. Europe and the UK, for instance, actually posted stronger than expected growth in Q1 2025.
Oh, that's interesting. Better than anticipated.
Yeah, definitely a positive surprise there. Something to note.
And China. We hear a lot about their 5% target. Still achievable.
Well, China showed resilience in Q1 too. Westpac seems to think that 5% target for 2025 is still within reach, partly thanks to new stimulus measures they brought in.
Okay, so Europe, UK, China showing some strength.
Yep.
But the U.S. picture is less rosy.
That's right. U.S. GDP dipped slightly in Q1, and the report flags softer consumer spending, even with those pull-forward effects.
You mean buying ahead of tariffs?
Exactly. Businesses rushed purchases, giving a temporary boost, but potentially meaning less demand later. Westpac actually sees bigger risks for the U.S. activity, jobs, inflation compared to other places.
And the Fed, what was their take on all this uncertainty?
The FOMC, yeah, they kept rates on hold. They specifically mentioned extremely elevated uncertainty.
Okay, so no quick fix from them.
It suggests policy relief, like rate cuts, is unlikely until the second half of the year, probably. They're watching closely.
Right. So, putting it all together, Westpac's global growth forecast for 2025, still the same.
They're sticking with their downgraded forecast of 2.9% globally for the year, recognizing, that things are still pretty uncertain.
Okay. Now let's zoom in on Australia. Sounds like the sluggishness we've been seeing is set to continue.
Unfortunately, yes. Westpac has nudged down Australia's 2025 GDP growth forecast again to 1.9%. That's down from 2.2%.
And that's linked to the U.S. tariffs and market jitters, leading to cautious consumers.
Precisely. And recent data seems to back that up. Consumer spending was restrained early in 2025, suggesting, downside risks remain.
What about trade? Any bright spots there?
Trade flows have been more positive for Australia, yeah. Though the report acknowledges some of that might be temporary, that pre-tariff rush effect again.
Okay. And inflation here, that's been the big focus for the RBA.
Well, the good news, relatively speaking, is that inflation is still pretty benign. The trimmed mean CPI, the core measure the RBA watches, is actually back inside the 2–3% target band, first time since 2021.
Right, so inflation is behaving, but the growth concerns are mainly about people not spending.
That seems to be a big part of it. The report notes a high proportion of recent tax cuts are being saved, not spent. That cautious behavior really dampens things. The RBA will likely have to revise down its own consumption growth forecasts because of that.
And it's not just spending habits. Other factors are at play.
Yeah, population growth is slowing too. That can feed into weaker spending and maybe soften the job market a bit. Oh, and interesting detail, Australia's trade got a boost from a surge in non-monetary gold exports in Q1.
Okay.
Yeah.
Any domestic political factors mentioned?
Just that the federal election result, with the incumbent government returned, removes one source of domestic uncertainty. But the fiscal outlook, government spending and all that, is expected to stay pretty much the same.
Right. Let's shift to commodities then. You mentioned gold. The report talks about a gold rush offsetting weakness elsewhere. Sounds dramatic.
It kind of is, yeah.
Yeah.
You had crude oil prices crashing below US $60 a barrel after OPEC Plus decided to pump more, just demand looks softer.
Ouch.
And iron ore fell below $100 a ton after Liberation Day, both key for Australia, obviously.
So big hits there. How did gold manage to offset that?
Well, gold prices surged, up 44% year to date when the report was written, a huge jump. And that rally was basically strong enough to cancel out the declines in iron ore, coal, crude oil. So the overall Westpac Export Price Index, the WEPI, ended up being flat for the year.
Wow. That really shows gold's safe haven appeal in action, doesn't it?
Absolutely. A classic response to uncertainty.
What are the forecasts now? Gold stays high. Oil keeps falling.
Westpac lifted its near-term gold forecast around US $3,400 an ounce, but they see downside risks for crude forecasting Brent at US $55 by June. Iron ore and met coal forecasts are unchanged, expecting a gradual decline. Oh, and they also flag a potential issue with declining Aussie iron ore quality, which could mean bigger price discounts.
Okay, something to watch. Now, global FX markets. The report says they're pivoting to growth. What does that mean exactly?
It means currencies are starting to move more based on growth prospects rather than just, say, safety flows. The US dollar slipped after the trade tensions flared up. It might be returning to the pack after being unusually strong, though weak US data could push it down further, of course.
So who benefited from the weaker dollar?
The euro and sterling, mainly. Partly dollar weakness, but also because their own Q1 growth surprised on the upside, and fiscal policy in Europe looks a bit more supportive. The report even mentions travel anecdotes suggesting potential for more gains.
Interesting. And Asian currencies, what's the story there?
These seem to be favoring growth prospects and trade flexibility. The Singapore dollar appreciated quite a bit against the US dollar. Taiwan, South Korea's currencies also saw strong gains. Yen less so. It suggests investors are looking at regions with better growth outlooks or those seen as more adaptable in this trade environment.
And our dollar.
The Aussie dollar rallied strongly, helped by signs the U.S. was willing to negotiate and evidence other economies could still grow. Westpac expects it to keep outperforming the U.S. dollar index going forward.
Okay. Let's quickly look at New Zealand. Similar themes. Some domestic strength, but global uncertainty.
Pretty much. Recent NZ data, before the trade war impact really hit, suggested ongoing improvement. Confidence was okay, housing market rising gradually, but there was a dip in consumer spending in March, and the job market was a bit mixed.
And the RBNZ cut rates.
They did, an expected cut to 3.5% in April. That takes their total easing to 200 basis points, which is, significant stimulus.
But the global picture is still the main worry.
Absolutely. The direct 10% U.S. tariff is seen as manageable, but the indirect effects weaker global growth hitting their terms of trade, that's the bigger concern. The NZ dollar has been volatile too. Westpac sees the RBNZ continuing a slow easing path towards maybe 3%, given all the uncertainty.
Right. Back to China quickly. Their ambitions still in hand for that 5% growth.
Westpac thinks so, yeah. Based on that strong Q1, consumption and net exports were key drivers, though household consumption is still a bit weak historically. Property investment is way down.
So government policy is crucial there.
Very much so. You saw a big jump in new loans and financing in March. Suggests policy easing is starting to bite, boosting housing wealth, equity markets. Support for the labor market is just starting. The aim seems to be boosting wealth and confidence to get consumption and investment going sustainably.
And their trade position.
Well, that strong net export contribution probably won't last. Their demand for U.S. goods is falling, which helps their trade balance for now. The report mentions a small risk. What if other Asian countries impose tariffs on China to get better U.S. access? Unlikely, Westpac thinks, but it's out there.
Okay. And finally, the U.S. The report uses the phrase, lack of confidence prevails. Sounds serious.
It does. The trade uncertainty raises the risk of stagnation, maybe even recession, and the Fed's hands are a bit tied by rising inflation expectations among consumers. Weak growth plus high rates isn't great for the federal budget either.
And the Q1 GDP contraction we mentioned earlier, driven by households.
Largely, yeah. A sharp slowdown in household consumption. Government spending also fell, housing investment stalled, business investment surged, but that was mostly that pre-tariff rush, which also pulled in a lot of imports, so not necessarily a sign of underlying strength.
And how are people feeling? Consumers? Businesses?
Sentiment, both consumer and business, has plummeted, and consumers are much more worried about inflation, mainly because of the tariffs. Growing anxiety about job prospects, too. Business surveys also point to downside risks for jobs and wages from the tariffs.
So Westpac's base case for the U.S.
Basically, stagnation. They expect the unemployment rate to rise, and even slightly weaker growth than expected will really strain the deficit.
Okay, one last area, the wider Asia region. Balancing currency risks, stimulating domestic demand.
Exactly. With the trade war clouding the export outlook, the focus shifts inward. But conditions vary hugely. India, Indonesia, Thailand, South Korea all face different challenges.
Right. India strong domestically but needs investment. Indonesia focused on currency stability.
Yeah, something like that. Thailand's very export-dependent, so facing headwinds.
Yeah.
South Korea has its domestic challenges, but leads in chips, which helps.
And central banks across Asia are cutting rates.
Many have started, yeah, to align with domestic conditions, counter slowing growth, especially as inflation risks have softened a bit. More easing is generally expected.
And Europe, after that strong Q1, what's expected for Q2?
Well, that Q1 strength, driven by industrial production and exports, possibly helped by that pre-tariff U.S. demand, might see some payback. Westpac expects a small contraction in both the UK and Euro area in Q2, partly the export effect reversing, partly the initial hit from tariffs on trade and investment.
So Q1 might have been a bit of a blip. What about longer term?
That really hinges on trade deals with the U.S. That UK-US framework helps specific sectors, but the main tariff is still there. Similar deals are expected elsewhere, like the EU. Westpac forecasts a gradual recovery in the second half of the year, helped by government spending in the euro area and consumers holding up relatively well.
Okay, let's try to wrap this up. Unpacking what this all means for you, listening in, it's clearly a complex picture, isn't it? A global economy really grappling with these big trade policy shifts.
Definitely. And you see that divergence. Europe, China showing some resilience, surprising resilience maybe, but the U.S. facing real headwinds. And that really shapes the whole global growth story. Australia's caught up in that, feeling its own slowdown linked to these global currents.
And what's really interesting for you, the learner, is seeing how interconnected everything is.
Exactly. That gold surge offsetting weakness in other commodities. Global currencies pivoting based on growth expectations and hopes of a trade thaw. These are really key dynamics you need to watch.
And the different paths being taken in Asia shows there's no single response to these challenges.
Right. So as you continue building your understanding, this report really paints a picture of a world in, well, transition. Reacting, adapting to policy shifts with mixed results. That uncertainty, especially around U.S. policy, it just highlights how fluid everything is right now.
Which leads to a final thought, perhaps, for you to consider.
Yeah. How might these global dynamics, the trade tensions, these different growth paths we're seeing, how might they influence the specific areas or industries that you're focused on? What are those potential knock-on effects, the ripple effects that might not be immediately obvious? It's complex, for sure, but hopefully this deep dive has given you a much clearer view of the key trends and the potential challenges ahead.